All right, let's keep going with some questions about corporations and stockholders, different types of stock, and all kinds of good stuff. So we said that we were going to come back to this question later. So let's see what we have. That is between slides 12 and 21 in the PowerPoint video presentation. So let's see, we got a true-false question to start off. It says the issuance of common stock affects both paid-in capital and retained earnings. All right, so let's just go through this. Common stock is owner invests, and the more formal way to present that on the balance sheet is through paid in capital. So we're good. However, when we talk about retained earnings, we need to understand what retained earnings are if we don't already know. Retained earnings come over from really from the income statement, and then we're going to subtract out dividends paid on common stock. But this asks about the issuance. So retained earnings are simply the amount of business earnings that have been retained by the business and not paid out in dividends. So this is the second, retained earnings is the second component to stockholders' equity. It has nothing to do with owner investment, and so this is going to be a false answer. Which of the following is not a right possessed by common stockholders of a corporation? So our first one says the right to vote in the election of board of directors. And I will just tell you right now that that is a right that common stockholders have. Preferred stockholders can't vote in these elections, but common stockholders actually can. Then we've got the right to receive a minimum amount of dividends. Choice C, the right to sell their stock to anyone they choose, and the right to share in assets upon liquidation. So I want to address choice D real quickly because it says the right to share in assets upon liquidation. This is technically true, even though common stockholders are pretty far down the list. We have to pay off all of our creditors and our bondholders first, and then our preferred stockholders are going to get taken care of. But if there's anything left in the event of a corporate liquidation, common stockholders would be entitled to that. So this technically, well, not technically, D is a true statement. Going back up one at a time, it says C, the right to sell their stock to anyone they choose. That is also true. And most of them have no idea who they're selling their stock to because it's done on the secondary market. But this is true. However, when we talk about the right to receive a minimum amount of dividends, this right is reserved strictly for what we talked about in the PowerPoint video, cumulative, let's see here, preferred stockholders. Okay, hopefully we can kind of halfway read my writing. So even preferred stockholders don't have a right to receive a minimum amount of dividends. Only if we're talking about cumulative preferred stockholders do we have this. So B is going to be our answer. Okay, let's see what else we have here on the other side of the page. I'm right up here. It says the par value per share of common stock represents, all right, so let's see what we have here. Minimum selling price of the stock established by the articles of incorporation. So this is not true. What the articles of incorporation does is the articles of incorporation will dictate whether, for example, common stock is par or no par stock, and if it is par stock, we will put the par value in the articles of incorporation. Now that can be changed down the road, but initially we're going to put the par value in the articles of incorporation, the number of shares that are have been authorized, but not the minimum selling price of the stock. Minimum selling price of the stock would refer to the market value. And so that's got two components of value there. B, minimum amount the stockholder will receive when the corporation is liquidated. We can't do this because we have to account for all of our creditors and also preferred stockholders if we have any. Dollar amount assigned to each share. This is end up being our answer. We will put in the article. We will say that that common stock has a par value of, say, $1 per share, something like that. 1 cent per share, $10 per share. Now, I want you to understand this has nothing to do with the market value of these shares. It's just a somewhat arbitrarily assigned dollar amount that goes to each share of common stock. If a corporation is liquidated, preferred stockholders are paid before the creditors and before the common stockholders. Well, after all, they are preferred stockholders, right? Except that we have a problem when this question, creditors must be taken care of first. Now, the second part of this with the common stockholders, that part's true, but we messed it up right up here with creditors. So this is going to end up being a false statement for that reason. Okay, let's see what we have here. All right, it says a class of stock having first rights to dividends of a corporation. Well, no par stock is, I just want to, kind of touch on some of the definite wrong answers here. No par stock is just a type of common stock that doesn't have a par value. So that's not going to be our answer. And I also want to D, treasury stock. We're going to get to that in another video. Those are both wrong. So that gives us a choice between A and C. And we said in the PowerPoint video that preferred stock was preferred as to dividends. And that is going to be our answer. All right, a small little workout problem here. This will be the last question we have in the video. It says something about Sabas Company, or something to that effect, has 20,000 shares of $100 par, 2% cumulative preferred stock, and 100,000 shares of $50 par common stock. The following amounts were distributed as dividends. And so we have year 1, 2, and 3. The question says, determine the dividends in arrears for preferred stock for the second year. And let's do this. Let's, just to make this crystal clear, let's get rid of the word for and replace that with the word after. Okay, so determine the dividends in arrears for preferred stock after the second year. Okay, so step 1, what we have to really do here is determine how much we owe these cumulative preferred stockholders on a year-to-year basis. Because remember, we had a question about this earlier. These cumulative preferred stockholders do have a right to receive a certain minimum amount of dividends. That minimum amount is going to be 2% of $100 for every share that they own. And in this case, we've got 20,000 shares that are out there. So the first thing we have to do is to determine amount owed to, and I'm going to abbreviate here, cumulative preferred stockholders. Okay? Now, we kind of said in that question on the previous page that, even though we said that the cumulative preferred stockholders are going to have a right to receive that minimum amount. However, we also said in the PowerPoint video that sometimes we can't pay them when, each year. and we said that dividends that have not been paid to cumulative preferred stockholders are said to be in arrears or behind. So let's look at step 1 here. I just want you to understand that they are owed this money, but they may not get it each and every year. So what we're going to do is, if it were me, I would take the $100 par and I would multiply that by 2%. Okay, let me get a calculator up here. Okay, make that a little bit smaller and put it right there. So $100, we could probably do this in our head, times 0.02, that's 2%, is $2. So this is going to equal $2 dividend per share. All right, and we're going to multiply this $2 times the number of shares, and that's going to be 20,000. So this answer here, $40,000, is how much we owe the cumulative preferred stockholders per year. Okay, we owe them $40,000 per year. Well, after year 2, we could say, okay, year 1 and year 2 is 2 years times $40,000 equals $80,000. But that's not exactly what the question is asking us for, is it? They want to know how much is actually still in arrears. And notice here that we paid out dividends in year 1 and year 2 of $10,000 and $45,000. Well, all $10,000 went to the cumulative preferred stockholders in year 1. And since we owe them $80,000 after year 2, we can basically just take these two amounts here and add those together. We can probably do that in our head. And that comes to $55,000. We're then going to subtract that $55,000 because we've already paid this amount. And that's going to give us our final answer of $25,000 in arrears after the second year.